In Japan, with an ever weaker yen, you go out to pips, which folks conventionally is 4 decimal points out. It's not Gladys Knight and the pips, it's every pip. And we're moving every pip higher on a weaker Japanese yen. What does that mean for those institutions in Japan? What's their level of panic at, say, 7 p.m. U.S. time?
I would say the level of panic is probably pretty high, but it's a difficult situation because, as you know, it's the Ministry of Finance that decides on FX intervention, not the Bank of Japan. The BOJ is merely the one executing intervention. And we had a situation last September, if you remember, where the MOF decided to intervene to stabilize the yen, but the BOJ remained really expansionary in terms of their monetary policy. And this is the problem they still have, right? I mean, the MOF is undoubtedly unhappy with the weakness of the currency. And, with every pip that we move higher in dollar yen, this problem worsens. But at the same time, we still have the BOJ sticking to its ultra-expansionary policy. It's still, giving some very dovish tones. So it's tricky to intervene, and there's a high risk of failure. I
look at secondary pairs here, like Australia as compared to Japanese yen. Which secondary pair do you study to get insight into weaker Japanese yen?
I think, to be honest, it really is mainly for us a question of looking at dollar yen and euro yen. I mean, obviously, if you look across the board, you will see the weakness of the yen, widespread. It's widespread. You could look at the trade weighted index to get a bit more of a feel of how that's affecting the economy. But ultimately, I think, trying to pick a level is always difficult because the BOJ and the MOF have in the past tried to avoid, sort of creating this line in the sand that they could then be beholden to. So this is why, obviously, they didn't intervene at 145. So they've set it out a bit longer, but with every day that passes, the pressure mounts.
Sonia, a lot of what Japan is watching is the same thing that everyone on Wall Street is watching, which is the Fed and what the threshold is to cut rates, which could give them a pass to move away from yield curve control. Do you think that it's overly ambitious to view all Fed rate cuts next year as a good thing for risk assets?
Not necessarily. I think, when you look at why the Fed is going to be cutting rates, I think you just discussed it before I came on the show. I mean, we're looking at a situation where growth is going to slow down, we believe, but it's not going to be, we're not talking about a recession anymore. We're talking about a very soft landing. And what's going to happen is as inflation declines, real rates will rise. And this means the Fed has scope to cut rates. So I would very much view it as the Fed having that opportunity to cut rates. This is not, I think, a situation in which rates are being cut in response to very weak growth. So I don't think that rate cuts are necessarily negative for the market as a whole.
We've been talking about the different outlooks for 2024 coming out. We already spoke about Morgan Stanley and Goldman Sachs. TD Securities came out with this today, basically saying that they expect more rapid pace of rate cuts than markets do starting from mid next year. Do you agree with that?
We also have the Fed cutting rates as of the middle of next year. The particular problem that we're going to have next year is, of course, that the Fed will have a certain window to cut rates, and then the election is going to come, and they can't cut right before the election. So our best guess is they're going to start cutting in the summer, pre-election, hot point, and then have to wait until after the election. So we're probably looking at 3 rate cuts next year. I don't know what the current consensus is, but it's probably in that vicinity, I'm guessing.